Urgent update for every American receiving Social Security, SSI, SSDI, or VA benefits. The date is January 17, 2026, and a series of massive changes have just gone into effect that you need to know about right now. This isn't just another small cost of living adjustment. We're talking about 5 specific critical updates to how your benefits are calculated, paid out, and even verified. And failing to understand them could literally cost you thousands of dollars out of your own pocket. We've just spent days poring through the latest federal announcements and internal directives to bring you the facts. We'll be breaking down a shocking new rule about your bank account, a change to eligibility that could catch millions by surprise, and a little-known adjustment that could drastically reduce your monthly payment if you're not careful. This is the information the agencies won't be mailing you in a simple letter. You cannot afford to be in the dark about this. If you want to protect your hard-earned benefits and avoid devastating financial mistakes, then you need to watch this video. Help us spread this critical warning. Please take a second and hit that like button right now. Alright, thank you for hitting that like button. It's more important than ever because what we're about to discuss is happening right now, and the financial shockwaves are going to be felt in millions of households across the country. The systems that so many of us rely on, Social Security, SSI, SSDI, and VA benefits, are not static. They are constantly being changed behind the scenes, and a series of major updates that just took effect for 2026 are some of the most consequential we've seen in years. These aren't just minor tweaks. These are fundamental shifts that could pull thousands of dollars out of your pocket if you're not prepared. So let's get you prepared, starting with the first and arguably the most modern financial trap that has just been set. The first major change is a massive expansion of the government's financial surveillance capabilities, specifically targeting needs-based programs like Supplemental Security Income, SSI, and the VA pension. We've talked before about how the SSA and VA can look at your bank accounts, but the new rule for 2026, which we're calling the Digital Asset Verification Mandate, takes this into the 21st century. The agencies have now been granted authority and have deployed new technology to automatically track and verify your holdings in digital wallets and payment apps. We are talking about your balances on platforms like PayPal, Venmo, Zelle, Cash App, and even cryptocurrency exchanges like Coinbase. For years, these have been a sort of gray area, but that gray area has now been eliminated. These are now considered countable resources, just like the money in your savings account. Here is why this is so dangerous. To qualify for SSI or the needs-based VA pension, you must have severely limited resources, less than $2,000 for an individual. Many beneficiaries use apps like PayPal or Venmo for small transactions, maybe selling a craft item online or receiving money from a family member for groceries. Over time, a small balance can build up. You might have a few $100s sitting in your Venmo account that you've simply forgotten about. Under the new system, the government won't forget. Their automated systems will flag that balance, add it to the money in your bank account, and if the total pushes you over that $2,000 limit, even for a single day, the consequences are severe. You will receive an overpayment notice, demanding you pay back not just the amount you were over the limit, but your entire benefit payment for every month you were deemed ineligible. This can easily run into thousands or even tens of thousands of dollars. It is a debt you will be forced to repay, often by having your future benefit checks garnished. The government is no longer relying on you to self-report these digital accounts. They are actively looking for them, and for millions of people on a razor-thin budget, this technological leap forward could feel like a giant leap backward into poverty. The second seismic shift is an aggressive new program from the Social Security Administration aimed directly at people receiving Social Security Disability Insurance, or SSDI. They are calling it the Work Activity Reevaluation Initiative, and it fundamentally changes how they monitor your ability to work. In the past, the SSA would conduct periodic reviews, maybe every few years, to see if your condition had improved. But now, they are moving to a system of continuous, data-driven analysis. The SSA is now cross-referencing its beneficiary roles with a vast array of other databases. This includes IRS filings for 1099 or freelance income, state business registries, and even publicly available information on social media. They are hunting for any sign of what they consider substantial gainful activity, or SGA. Let's be clear about what this means in the real world. Imagine you're on SSDI because of a severe back injury that prevents you from doing your old construction job. To make ends meet and keep your mind active, you start a small online shop selling custom-printed t-shirts. You're not making much, maybe a few $100s a month, well below the official SGA threshold. However, under the new initiative, the SSA's algorithm might flag the registration of your online store or see your public business page on Facebook. This could trigger an immediate and invasive review of your case. You will be buried in paperwork, forced to justify every dollar earned and prove that your activity doesn't demonstrate an ability to return to the workforce. The stress alone can be debilitating. For those who do make a mistake and earn over the SGA limit, even for a month or two, the consequences are catastrophic. The SSA can terminate your benefits and issue an overpayment notice for every single month they decide you are engaging in SGA. This new initiative creates a chilling effect, punishing beneficiaries who are simply trying to be productive in a limited capacity, and it could cost them the only stable income they have. Now, let's pivot to those of you in retirement, because the third change is a bureaucratic nightmare that is going to blindside countless seniors who thought they were doing everything right. The Social Security Administration has publicly admitted to a major long-running software error in how they calculated delayed retirement credits. These are the credits you earn for waiting past your full retirement age to claim your benefits, a bonus meant to reward you for your patience. The error caused the SSA to miscalculate these credits, resulting in slightly higher monthly payments for a large number of retirees. Now, they've fixed the software for the future, but their solution for the past is nothing short of cruel. They are initiating a massive clawback campaign. Retirees who were unknowingly affected by this error are now receiving letters stating that they were overpaid and that they owe the Social Security Administration thousands of dollars. Imagine you're 75 years old, you delayed your benefits until age 70, just like the experts advise, and you've been living on a fixed income. Suddenly, you get a letter saying that because of their mistake, you now have a debt to the government for $8,000. You are given the option to pay it back in a lump sum, which is impossible for most, or to have your future Social Security checks significantly reduced for years until the debt is paid. It is a gut punch. You followed the rules, you planned your retirement based on the benefit amount they told you that you were entitled to, and now you are being punished for their error. There is a waiver process, but it is complex and puts the burden of proof on the retiree to show that the overpayment wasn't their fault and that paying it back would cause financial hardship. It's a David and Goliath fight that could financially devastate seniors who did absolutely nothing wrong. The fourth major change is aimed squarely at our nation's veterans, and it is a direct hit to the financial stability of many who are living with disabilities. The Department of Veterans Affairs has announced a significant overhaul of the rules governing concurrent receipt. This is the policy that allows some disabled veterans to receive both their full military retirement pay and their VA disability compensation without any offset. For years, this has been a lifeline. However, the new 2026 rule tightens the eligibility for this dual payment, specifically for veterans with disability ratings that are not directly classified as combat-related. The VA has reevaluated and reclassified a number of common service-connected conditions, such as certain musculoskeletal injuries or chronic illnesses that may have developed during service but not in a direct combat situation. The practical effect of this reclassification is that thousands of veterans who have been receiving both payments for years will suddenly no longer be eligible for concurrent receipt. Instead of getting two separate checks, they will now have their military retirement pay reduced dollar for dollar by the amount of their VA disability compensation. Let's be perfectly clear. This is a massive, immediate pay cut. A veteran receiving a $1,500 monthly military pension and $1,200 in VA disability could suddenly see their overall income drop by $1,200 a month. That's a loss of over $14,000 a year. This isn't a small adjustment. It's a life-altering change in income that can affect their ability to pay their mortgage, cover medical bills, or support their families. For veterans who have built their financial lives around the promise of receiving both the retirement pay they earned over a career and the disability compensation they are owed for their service-related injuries, this overhaul feels like a profound betrayal. Finally, the fifth change is the one that will affect every single person receiving any kind of Social Security or VA benefit. It's a subtle but incredibly powerful change to the way the annual cost of living adjustment, or COLA, is calculated. Starting this year, the government has officially shifted the formula. For decades, the COLA was based on the inflation rate from the previous year, using a metric called the CPIW. This meant that if prices for gas and groceries shot up last year, your benefit check would see a significant increase this year to help you keep pace. However, the new formula scraps this immediate response model and replaces it with a rolling 3-year average. The stated purpose is to smooth out volatility, but the real-world effect is a hidden systemic reduction in your purchasing power. Let me break down what this means. Let's say inflation was very high last year, at 7%, but in the 2 years prior, it was much lower, say 2% and 1%. The old COLA formula would give you a raise close to that 7% to match the prices you are actually paying at the store right now. But the new formula averages those 3 years together, so it would average 7%, 2%, and 1%, resulting in a COLA of only 3.3%. Your benefit check goes up by a measly 3.3%, while the cost of everything around you went up by 7%. You are now thousands of dollars poorer in terms of real purchasing power over the course of the year. Your benefit check is simply not keeping up with your actual expenses. This is a stealth cut that affects all 70 million beneficiaries. It doesn't feel as direct as a clawback notice, but over time it is just as damaging, quietly eroding your standard of living year after year. These 5 changes, taken together, paint a grim picture for 2026. They represent a coordinated push to tighten eligibility, increase surveillance, and reduce payouts across the board. From the digital tracking of your PayPal account to the data-driven reviews of your work activity, the clawing back of benefits paid in error, the gutting of concurrent receipt for veterans, and the watering down of the COLA, the message is clear. The systems are getting harder to navigate and less generous. It is more important than ever to be vigilant, to understand these rules, and to be your own best advocate. You must be proactive. Review your accounts, understand your work limitations, scrutinize every letter you receive, and budget for the reality that future cost of living adjustments may not be what you expect. Let's continue, because simply knowing about these problems isn't enough. You need to know how to shield yourself, how to prepare for the letters that might be coming, and how to navigate this new, more hostile environment. The feeling of helplessness is exactly what these bureaucratic systems count on, but knowledge and preparation are your shield and sword. Let's move from the what to the what to do. For that first change, the digital asset verification, your action plan needs to be immediate and absolute. Tonight, I want you to sit down and conduct a full audit of your digital financial life. Open every single app on your phone: PayPal, Venmo, Cash App, Zelle, even your Starbucks app if it holds a balance. Check for any stored money. Many of us receive a payment and just let it sit there, out of sight and out of mind. That is no longer an option. Your new rule must be to treat these apps as a conduit, not a container. The moment money comes in, you must transfer it immediately to your primary bank account. Never let a balance linger. This isn't about hiding anything. It's about simplifying your financial picture so that you and the government are only looking at one clear, manageable resource pool. This single habit could save you from a devastating overpayment notice triggered by a forgotten $150 sitting in a PayPal account. Next, for those of you on SSDI who are rightfully terrified by the Work Activity Reevaluation Initiative, your defense is meticulous, obsessive record-keeping. If you are doing any kind of freelance work or have a small side hustle, you must treat it with the seriousness of a corporate accountant. Open a separate bank account used exclusively for that activity. Every dollar you earn and every penny you spend on business expenses must go through that account. Keep a detailed monthly log. Write down the exact dates and hours you worked, the income you received, and keep it well below the substantial gainful activity (SGA) threshold. You must be prepared at a moment's notice to hand the SSA a folder that proves beyond a shadow of a doubt that you are following the rules. Furthermore, be incredibly mindful of your digital footprint. If you have a public-facing website or social media page for your hobby, choose your words carefully. Avoid phrases like working full-time on my passion, and instead use language that reflects limited, part-time activity. You are living in an era where a single ill-advised Facebook post could trigger a devastating benefits review. Now, for our seniors who are facing the terror of a delayed retirement credit clawback notice. The most important thing I can tell you is this: do not panic and do not ignore the letter. The moment you receive a notice of overpayment, you must act. Your first step is to immediately file Form SSA 632, which is the Request for Waiver of Overpayment Recovery. This is your critical defense. On that form, you must argue two main points. First, that the overpayment was not your fault. In this specific case, the SSA has already admitted it was their software error, which makes this part straightforward. Second, and this is the key, you must prove that paying the money back would cause you financial hardship. This means you must demonstrate that you need substantially all of your current income to meet your ordinary living expenses. You will need to gather proof of your monthly bills, your rent or mortgage, utility bills, food costs, medication co-pays, everything. You are making the case that their mistake, if forced upon you, would prevent you from affording your basic needs. Be aware that there are strict deadlines to file this waiver, so you must act the moment you get that letter. For our veterans who are about to be hit by the changes to concurrent receipt, your first move is to seek expert guidance. The Department of Veterans Affairs is a massive bureaucracy, and its rules are incredibly complex. You need a navigator. Contact a certified veteran service officer or VSO immediately. Organizations like the VFW, the American Legion, and Disabled American Veterans, DAV, offer these services for free. A good VSO can look at your specific disability ratings, review the VA's new classifications, and tell you exactly where you stand. They will know if your conditions are among those being reclassified and can help you explore your options. In some cases, it may be possible to file a new claim to link your conditions more directly to combat-related activities, or to appeal the reclassification. Trying to fight this battle alone is a recipe for disaster. A VSO is your single most important ally in protecting the benefits you earned through your service. Finally, we have the systemic erosion of the cost of living adjustment. This is the hardest one to fight individually because it's a change to the fundamental formula. You cannot file a waiver against the COLA. Therefore, your only defense is to change your own personal financial formula. You must shift your mindset from relying on the government to protect your purchasing power to creating that protection yourself. You have to become a ruthless budgeter. Every single dollar must have a purpose. You can no longer assume that next year's benefit increase will cover the rising cost of your groceries or gas. The math now guarantees that it won't. This means you must create your own buffer. This might sound impossible when you're already on a fixed income, but even small changes can add up. It might mean cutting a streaming service, changing grocery shopping habits, or consolidating errands to save on gas. More importantly, it requires a long-term mental shift, recognizing that your benefits are a slowly depreciating asset and that any personal savings you can possibly scrape together are more critical than ever before. In the end, all 5 of these changes point to a single, undeniable truth. The era of passive benefit receipt is over. You can no longer just expect your check to arrive and for the system to take care of you. You must now be an active, vigilant participant in your own financial survival. You must be a record keeper, a budgeter, an auditor, and an advocate. You must question everything. Read every piece of mail from these agencies with a critical eye and be prepared to defend yourself. It is an exhausting and unfair burden to place on people who are often the most vulnerable. But in this new environment, Vigilance is the only currency that matters. Please, use this information to build your defenses. Share it with at least one other person who needs to hear this. The more we all know, the harder it is for us to be caught by surprise. Thank you for your time and for your commitment to staying informed. Subscribe for more updates, and let's navigate this challenging future together.